You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, Your Key to Understanding Options, a discussion with the pros. We'll take a deep dive into basic options concepts with a panel of experienced professionals who will help you understand how options fit into bullish, bearish, and sideways market situations. As always, we'll cover the material in a quick 60-minute session. Our moderator for today's panel is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. And now, ladies and gentlemen, Joe Burgoyne will introduce our panelists for today's topic, Your Key to Understanding Options. Joe?
Nick, thanks so much, and thanks to everybody for joining us today. I'm excited about the next 55 minutes or so. As Nick said, we've got 3 dynamite panelists. We are really, as I think many of you know, the theme this month at OIC is Options 101. It's really about building that foundation of knowledge, especially for those of you just getting started in options. With that, let me introduce our panel of 3. I'll start with Ed Modla. Ed's with Investor Services here at OIC. Welcome, Ed, and why don't you tell everybody a little bit about yourself?
Sure, Joe, thanks, and it's good to be here. I'm going on about 19 years in the business, starting out with my finance degree right to the trading floor in Chicago, spent time trading in the pits at the CBOE, the Mercantile Exchange, and also at the Amex out in New York. Went from the pits to the screens and traded for a number of years there, equities, options, and futures contracts before entering the service side of the business. I was a Series 3 licensed broker for a number of years, working with traders in their futures investments and their options on futures investments. And then in 2014, I teamed up with the guys here, and now I manage the investor services team, working with investors and traders and playing an integral role with the Options Industry Council. the construction and maintenance of the content on the website, optionseducation.org, and also involved with the presentations such as the one here today.
Yeah, and I want to thank you. You did a great job last week with 8 essential option concepts. I know you offered that webinar last week, so happy to have you. Next is Peter Lusk. I'm sure many of you out there know Peter. He's a senior instructor at the CBOE Options Institute. Welcome, Peter. And how about if, for those maybe few folks out there who don't know you, tell us a little bit about what you're doing.
Sure. Thanks, Joe. A lot like Ed, I started out in the pits here in Chicago in 1992 and became an instructor here at the Options Institute, which is the educational arm of the CBOE, in 2007. And have really been enjoying my time up here educating retail and institutional investors.
Well, I know also you're out on the road, teaching on behalf of the OIC. Peter, you do a great job, and thanks for that, and thanks for, joining us today. And last and certainly not least, Dr. Alan Ellman is joining us. Alan's business is the Blue Collar Investor. Alan, why don't you introduce yourself to the folks and tell them something about what you do?
Sure, Joe. Well, I started my professional career actually as a dentist. And in the early 1990s, I started teaching myself how to self-invest, first with stocks and then with stock options. And I started having a high degree of success, so it became more than a hobby. It became a passion. That ultimately led to my writing my first book, Cashing In on Covered Calls, which went to #1 on Amazon.com on the topic of covered call writing. Since then, I have a total of 6 books published, 5 on stock options. I've also written over 300 journal articles and produced over 250 videos on topics related to selling stock options. In addition to that, I've written articles and columns for financial journals like iVolatility.com, Investing.com, Traders Inc., and the Journal of the American Association of Individual Investors. I'm a national speaker for The Money Show, Stock Traders Expo, and I do hold, Joe, a Series 65 as an investment advisor rep, but I choose to spend my time educating retail investors on how to generate cash from selling options as opposed to actually investing money for other people. So options has actually been a significant asset for me, both from a financial and a career perspective. I haven't picked up a dental drill in several years now.
Well, we met, as you know, Alan, just recently back in November at the AAII conference. We've had the opportunity to do a few things together since then, and we thank you for making time today. Listeners, this is why I'm looking forward to the next 50 minutes. 3 experts with varied backgrounds. Let's get started. The concept, as I said, for the month is Options 101. How about if we start one at a time? And Peter, how about if we start with you? It's a blank canvas. An investor hears about options, doesn't know anything. How would you advise somebody just getting started with options to start?
Well, Joe, just everybody being here today is a great start. I can tell their interest has been piqued just by that. I think the way to start is just to learn the option basics. And there's so much free education out there. I'd like to certainly plug us, but there's a lot of free education out there. Webinars that we have for free on our website. I would start with that, learn the option basics. And as you think about it this way, and Alan and Ed know this as well as you, Joe, that an options trader has to have a 3-part forecast, right? What's the stock going to do? How long it's going to take to do it? And our expectation of volatility. So really, I'd like everyone, as they learn the basics, somehow graduate to the point of learning option pricing, because that's really what it comes down to. You're going to try to take advantage of the changes in option pricing, whether you're Alan doing covered calls or you're me sometimes doing directional trades. You're trying to take advantage of option pricing. So with that being said, write that down. That's going to be your homework. I know today's a basic seminar, but at some point you're going to want to really delve into the Greeks. And one other comment. When I started out in the pits here in Chicago, I was not alone. I started out with a firm, and I had a lot of guys I could talk to and learn from. But when I go out on the road for you guys, Joe, and I meet people, it's somewhat alarming to see how many are just trying to go through this all alone. And I think trying to learn options all by yourself can be a really lonely endeavor. So it's kind of good to partner up with people, maybe join a local group in town that you have. And I guess that would be my advice as far as starting out with
Fantastic, Peter. We're off to a rip-roaring start. Boy, oh boy. Alan, how would you advise listeners? You do this all the time, getting started in options.
I would say that there has to be a 3-point plan. And I'm going to give you a very general 3 points, and then I'll get into a little bit more. Number one is education. I think everybody would agree to that. And, of course, certainly the Options Industry Council is a great place to start. I've been using the material that you guys have been providing for years now. But there are many other resources to use, and education is critical. But part of that education process, the second point, would be to paper trade. And that just means to practice. Because whatever you learn by reading a book or attending a webinar, going to a live seminar, you need to actually integrate that in the process. So what I would do is educate myself, but before I actually risked even 1 penny of my hard-earned money, I would based on the particular strategy that I've chosen. At that point in time, once you've developed the skill and the confidence, then you could begin the process of generating cash. Now, you have to select a strategy. There are so many different option strategies, and there is no one strategy that will meet the needs of every single investor. Now, I'm biased to covered call writing and to selling cash-secured puts, and I would actually recommend that that's where many in our audience should start, because it is a very basic, conservative strategy, and one big advantage of covered call writing is that the government considers this strategy low risk enough that it will allow us to use it in our self-directed IRA accounts. So while we're generating this monthly cash flow, we don't necessarily have to have Uncle Sam in as our partner. Again, as you paper trade and practice, you'll be building up your skill level, you'll be building up your confidence, and then you'll have years and decades to benefit from whatever option strategy you ultimately decide on.
Good start, Alan. Thank you. And Ed, how would you approach just getting started?
Well, everything that's been said here has been absolutely fantastic. I'll try to pick up some pieces and approach this more from organizing your education, because, of course, that's where everyone's starting. What I would suggest is to treat this as though you're enrolling in any other kind of course. If you're starting a course in high school or in college, what you start with is a syllabus or an outline that has major topics and subcategories. And I would encourage people to craft something like that for themselves using whatever educational reference you have at your disposal, such as the Options Industry Council's website, and put together an outline for yourself. Peter mentioned starting with option basics, and that's a great idea for your first major topic, option basics, with subcategories that you can define for yourself, such as terminology, exercise and assignment, what do different definitions mean, and then go through those so you can reference yourself, track your progress, and then review and quiz yourself just the same way you would if you were going through any other course. And that way, as you get through towards the intermediate or towards the end, you can then look back on the subjects and topics above, and you'll realize and recognize which ones you might need to go through over and over again. And that leads into sort of my second recommendation as you're doing your education. Pay specific attention to repeating material. I personally think that the characteristics of options are very understandable and they're logical and they make sense. When I talk to investors and traders, you can hear the light bulbs go on the other end of the phone when you talk about it because they do follow logic, but they're complicated, and learning options takes time. So I would encourage everyone out there to repeat and review material over and over again. Read through things multiple times. Go through webinars like the one we're doing here today over and over again to drive home these concepts. So from the educational perspective, organize, know what topics you want to review and understand, and then focus on a repetition so that sooner rather than later these concepts will become second nature for you.
Excellent, Ed. And I think, one of the things I wanted to ask you guys, and Ed, you may have really just spoken to it. My experience when I was first learning about options was that, they weren't necessarily real complicated, but they were definitely confusing. And Ed, you're talking about, repeat that education. To any of you, do you agree, first of all, that options, when you first get started, are confusing? And if so, any secrets as to how to, kind of demystify them and keep them clear?
Joe, everybody wants to jump in. Go ahead.
This is Alan. When you're selling options, which are the strategies that I use, for covered call writing, for example, you buy a stock, let's say at 48, and then you sell the option, agreeing to sell it at a price that you determine. In this hypothetical, let's say you agree to sell it for 50. Now, when you sell a put, you're agreeing to purchase shares at a certain price. So as an option seller, we know that the option will be exercised if the strike price ends up in the money at expiration. So you have to be able to determine whether or not a strike price is in the money. This can be very, very confusing when you're talking about calls and puts. So one little trick that I started using years ago and I teach in my seminars is to ask yourself, is the strike price, if it's exercised at that point in time, will it benefit the option holder or the option buyer? So let me give a quick example of what I mean by this, and then perhaps this is a little trick that some of our listeners can use in the future. Let's assume for a moment that a stock is trading at $75, and let's evaluate the $72.50 strike price. So we ask ourselves, is this in the money for a call option? Call option means that the buyer of the option has the right to buy the shares for $72.50. Well, yes, because the call buyer can buy the option for $72.50 and sell it at market for $75, thereby generating a $2.50 profit. So therefore, that $72.50 from the call perspective is in fact in the money. Now have a look at that same $72.50 strike from a put perspective, which gives the holder the right to sell their shares for $72.50. Is that in the money for puts? Well, no, because they could sell the shares at $72.50, but that's lower than current market value. So the takeaway here is based on the fact that it does benefit for the call, but not for the put, that it's in the money for calls, but out of the money for puts. This can be a little confusing initially, like you said, Joe, but like anything else, once you practice it, once you educate yourself, it'll become very second nature.
Peter, you had something you wanted to say.
Well, it was kind of dovetailing on what Ed was talking about a little bit too. I'm looking forward to going out to Santa Clara for the OIC on March 8th, and I'm sure I'm going to tell them what I'm going to tell everybody right now is this. They have the slides, or they can print the slides, whatever. I tell them, based upon probably my mom was a school teacher, I probably get this from her, I said, look, most of you came here tonight by yourselves. Don't just put this book on a shelf when you get home. Go through it and show somebody else at home or at the office what you learned tonight. I think when you go through it again in that manner, you're kind of ingraining it again in your own head. That's kind of the tack that I've taken all my life when I learn something. I try to become, not just the student, but I become the teacher again so that I can kind of, get it ingrained in my head. Just a thought.
Okay, indeed you have. And Ed, anything, you were talking about that repetition. You want to, anything to add?
Yeah, and you mentioned the confusing nature of options, how they do follow logic, but they can be sometimes hard to understand. There's so many details involved when you're learning about options. So one of the things that I am a big advocate of, and for those of you who have heard my recent webinars, I drive this point home, creating charts and graphs for yourself I think is very useful. And, for example, when you think about calls and puts, of course, there's rights and obligations attached to each. And, there's only 4 sides you can have with an options position. You're either long a call or you're short a call, or you're long a put or short a put. Those are the 4 sides you can be on. Each of those 4 has rights and obligations attached to it. So you can create a chart for yourself with 4 rows, each of those 4 positions, and then create columns for yourself. Rights and obligations can be one column, and then fill in the blanks How much would change hands upon exercise or assignment? Is there a debit or a credit? And fill in the blanks. So as you're going through your education, you can create a little cheat sheet chart, if you will. And also when it comes to strategies, being able to draw a profit and loss graph at expiration, I think, is incredibly helpful for investors to be able to visualize where the risk is and where the reward is for a certain options trade. You know, just the mere fact that you're going through the hard work and putting pencil to paper and drawing things out and writing things out, that will help you remember these concepts and ideas, just going through that hard work. So creating charts for yourself, using them as quick reference points, drawing P&L graphs, I think it's a great way to learn about options from a beginner's perspective, put things into perspective, and maybe help you overcome some of these confusing details because you can reference them over and over again many times.
Excellent, Ed. Peter, I'm going to go to you with the next thought here. Do you get a sense that there's a particular skill set that the average investor needs in order to understand options, or can anybody do this?
Well, first of all, if you like it enough, I think you're going to be good at it. Matter of fact, when I started out in the pits, I didn't make any money for 13 months, and I remember going home at night telling my wife some of these funny tales about the guys in the pit. And, after 33 years of marriage, she's obviously not high maintenance, but she did say to me that night, she said, Peter, I'm glad you're having fun, but, when are you going to start making some money kind of thing, So if you do like it, you're going to be good at it, just like anything else. If you like to ski or play tennis, you're going to be good at it. But some of the other skill sets, don't get emotional. I know it can be emotional for some people. Losing money certainly can hurt, but you've got to keep your emotions in check.
Is there a way to do that? That you have found through years of experience?
Probably comes from the days of playing cards in college, Joe, but we don't like to present options as gambling by any means. I think for me it just comes from the pit. Nobody ever knew if I was making money or losing money. I just had kind of a straightforward face and stuck with moving forward. So I would always leave emotion out of it for sure. And if you find that it's frustrating, you're just not getting it, and you're breaking your number 2 pencil on your desk, then give it up and maybe try something different. Maybe it's just not for you. We're all here today to say, yeah, we'd like it to be for you, but it's not for everybody. That's certain. It's not for everybody.
Indeed. Alan, your thoughts?
Yeah, I'd like to give you 3 very specific skill sets that I believe are critical, specifically for covered call writing and selling puts, but probably for every option strategy. Number 1, you have to be able to select the appropriate underlying security, be it a stock or an exchange-traded fund. Not every stock or ETF makes a good option trade, and you should base that selection based on the volatility of the underlying security. That will dictate the premium, the option premium as well. And that doesn't mean you should make your selection based on the most volatile stock that generates the highest premium. So selection of the underlying stock is critical and the first required skill. The second one is selection of the most appropriate option. Let me give you a quick example of that. If you bought a stock at 48 and agreed to sell the $50 call option, which is out of the money, that's a bullish position to take and the appropriate in certain market environments. But if the market is bearish or volatile like it's been lately, you might want to opt for the $45 in-the-money call option, which will give you additional downside protection. Now, to beginner investors, this may seem a little intimidating, a little complicated, but the takeaway here is that there is no one particular option strike that's appropriate for every single market condition. So you have to master the skill of option selection. And the final skill is position management. Because once you enter that trade, you buy the stock, you sell the option. Once you enter that trade, what do you do if the price of the stock goes down? What do you do if the price of the stock goes to the moon? What do you do if there's a dividend distribution and you're afraid that the option is going to be assigned and you're going to lose your shares and not collect that dividend? What are you going to do if the price of the stock is higher than the strike price? You don't want to lose your shares. So you have to be prepared. And I agree in a non-emotional way what to do in every scenario that can come up. So to summarize, you have to have these 3 required skills and not 2. 2 is not good enough. how to select the underlying security, how to select the most appropriate option, and then how to manage your positions after you've entered the trade.
Ed, I'm going to come to you in just a minute, but Alan, I want to go back to you. 3 very specific skills, but heck, if I'm starting out, I'm thinking that's going to take me a heck of a long time. Talk to me about that.
Well, you know, on the surface, it does seem that way. But the first part of it, stock selection, most people are familiar with that. So how do you select a stock? Well, I have a 3-pronged approach to that as well. I use fundamental analysis, earnings and revenues growth. I use technical analysis, how to read a price chart. And then I use certain common sense principles like minimum trading volume. Now, once you start using these screens or screens that you select on your own, and just do it over and over and over again, it'll become second nature to you. So that's the stock selection part. The option selection part is pretty intuitive. You want an out-of-the-money call if you're bullish. You want an in-the-money call if you're bearish. Just all you have to do is look at an options chain, take a look at the returns, and if we have time at the end, Joe, I could tell your listeners how to get free copies of the calculators that I've developed that will give all the math. You'll be able to figure out what your returns, protection, upside potential are for each of these trades. As far as position management is concerned, it's like everything else. If A happens, you do B. So you could actually respond to what's going on in the market in a very non-emotional manner as long as you have practiced, educated yourself. As I said before, paper trade is critical, and then you'll develop the confidence and the skill level to then start investing your hard-earned money. But until you've mastered those 3 required skills, I strongly suggest that you not invest even 1 penny of your hard-earned money.
Very good, Alan. And Ed, you know, you have a unique perspective where, you know, oftentimes, you know, you're hearing from investors all day long. So how about your thoughts on particular skills needed?
Yeah, everything that's been said has been great, so I'll try to offer a little different perspective there. One thing that comes to mind is that, generally speaking, options traders, they need to take their investments seriously, and they need to pay attention to the markets actively. And that's one thing, Joe, as you mentioned, that comes across my desk as I speak to traders and investors, is that there sometimes is a mindset that the options trade works for themselves, and if they just learn options, they can be profitable. And you know, it generally doesn't work quite like that. To pick up a little bit on what Alan just said, you have to have the market outlook. That's phase 1. You have to be able to develop a market bias, a bullish, bearish, or neutral. And then once you've derived that opinion, the options trade fits that narrative. So your options knowledge is sort of your arsenal. What can I use within my options bank to capitalize on the market opinion that I already have? And too many investors seem to forget that first part. They think options just work on their own. But you really have to have the market outlook, and that means time needs to be spent. And you need to do some technical analysis or fundamental research, or through whatever avenue you have to try and reach out and develop a market opinion or a bias on an underlying, then take that opinion and fit the correct options trade to that narrative, and then continue to monitor that trade. You may not have the same opinion tomorrow that you had today, and when that opinion changes, you have to ask yourself, is my options position still the one that I want to have on? It might not be. And the beauty of options, they're flexible, they're unique tools. You can make a few adjustments to your position and reshape that investment to fit a new narrative. So you have to be flexible, and of course, this means paying attention to the markets, watching them every day, taking your investments seriously. And to pick up a little bit on what Peter had said, I would say discipline is a major skill set that needs to be within the ability of each investor of options. One of the things that comes to mind when I invested professionally full-time was, in order to maintain my discipline, I set rules for myself, when to get out of certain trades, how much max loss to take on certain trades. And to drive the idea home, I'd leave myself reminders right on my computer monitor, sticky sheets with reminders telling me when to get out of trades. Constantly, all day long, I was forced to remind myself, if I have this amount of a loss, I have to exit this trade. It was forced discipline that I put on myself. So that's, you know, just an example, but having that discipline and figuring out a way to stay within your strategy and within your parameters is also very important.
I think what Ed just said is so important, particularly for beginning option traders, is that you can actually take an option strategy and craft it to the particular market environment that you're dealing with. So you can take covered call writing and make it a bullish strategy, or you could take it and make it a bearish strategy, depending on the strike price and the type of stock. And you could do this basically for all option strategies. So the flexibility and the fact that you could tailor it, and you must understand the current market environment, is such a critical point that Ed just made. And I hope that that it rings true to a lot of our listeners out there, because that's a good reason to consider option trading.
Let's, because we are Options 101 this month, I want to be sure that some of our listeners, we may be, it's hard to keep everybody happy in terms of speaking to the right level. How about if we back it up just a little bit, and Ed, I'm going to go to you. Just, with some of the nuts and bolts. What's a call, what's a put, and the rights and obligations of each? How about if you just, speak to our listeners about that briefly?
Okay, well, a quick description. There's two types of options. You have call options and put options, and when each is traded, there's two sides to the trade. Like any other investment, you have a buyer and a seller. And when you buy a call option, you are paying upfront premium debited right out of your account, and you are purchasing the right to execute a transaction in underlying shares of stock. So for the call buyer, you are paying for the right to buy shares of stock at a specified price. If you're on the other side of that trade and you're a call seller, you receive premium that's credited into your account right away up front. But you take on an obligation. You don't have a choice whether or not you can make this transaction. You're obligated to sell shares of stock if you're selling a call option at a specific strike, at the specific price that the option defines. And options in general have an expiration date, so the right that the caller buys and the obligation that the seller undertakes are good up until the expiration date. For put options, they're a little bit more confusing. They're on the opposite side, so it might take going through this a few times to get it clear. But if you buy a put option, well, similarly, you're paying premium up front, and you're receiving the right to execute a transaction in underlying stock. For a put, that transaction would be to sell shares of stock at the strike price defined within the option. If you're selling a put option, you're receiving premium, just the way the call seller receives premium. That's credited into your account. That's yours to keep. But you are now undertaking an obligation to potentially buy shares at the strike price of the option. And you see here a few terms. Whether or not it's a call or put, if you're buying an option, you are considered to be going along that option. And whether or not you're selling a call or a put, either way, you are short the contract if you're selling it. Also, a common term that you will come across is writer, or you will have written the contract.
Good, Ed. Thanks for laying that foundation. I think oftentimes I know when I'm presenting, I like to talk in terms of examples. How about if we center around good old XYZ, the favorite stock at OIC? How about if we talk about XYZ as a $40 stock? And Peter, would you speak a little bit to in the money, at the money, and out of the money calls and puts for that $40 XYZ stock?
Sure. You've got a great slide there that'll show in the money, at the money, and out of the money also. As we find the slide, basically if I've got a call option with a strike price below 40, that means that option is going to be in the money. And with that being said, we've talked about options. Buying a call option gives you the right but not the obligation to purchase shares of stock. I believe most option traders actually trade the options. So you can actually trade the option right back out into the marketplace with no intent at all on purchasing shares of stock. I wanted to mention that. Oh, good. You got the slide up here. So a call is in the money when the stock price is above the strike price, which this is a great slide. At the money is when the call is going to be, at the price of the stock. The strike price can be at the price of the stock. Or we even say that if the strike price of the option is a 50 strike, we like to also say that and if the stock is at 50.5, yeah, that's still considered to be the at the money call option. And a call is out of the money, of course, if the stock price is below the strike price.
Okay, and yeah, let's go with the $50 XYZ rather than 40. How about on the put side? How does that differ?
Yeah, the puts, okay, for the put is going to be in the money if the stock price is below the strike price. And it's kind of good to take it out of the textbook. I think even Alan might have been alluding to that earlier, is that, you know, all these slides look difficult at times, but think about it in terms, if I buy a put option, let's use the 50, my slide is blinking here, Joe, but let me just ad-lib it here. Let's just say that the stock price is at 50. If I've got the 60 price put, 60 strike put, that means I've got the obligation to sell shares at 60. All right? So take it out of the textbook. Think about it in terms of the stocks that you follow and not always the XYZ. And as far as following stocks, I like to actually follow the stocks that interest me, the corporations that interest me. I mean, the ones that come to mind immediately is Cree Research, which was one of the stocks that was very heavily traded in my pit, as well as more of the notables like Apple and even Abercrombie and Fitch. So that I'd like just to add as well, Joe.
I never heard of Apple, but we can talk about that some other time, I guess. Everybody loves Apple.
I think Peter mentioned something important, just to reiterate, that at the money by definition is when the strike price equals the stock price. But in practice, it really is the strike prices that are very close to the stock price. So if you see on the screen here, 50 strike price equaling the stock price of 50, you know, like Peter said, when you're looking at the 49.5 strike price or the 50.5 strike price, that range, without being too specific, that range of strike price is very, very close to the stock price is considered the at-the-money strikes.
How about if we I use this topic here to show our listeners how money can be made selling options. For example, we were talking about in the money, at the money, out of the money. When you're selling options on a stock that you already own, what you're doing is you're selling somebody, some unknown person, the right but not the obligation to buy our shares at a price that we determine. So if we have XYZ at 40, and let's assume for a moment, I want to keep the numbers a little smaller than $5 increments. Let's assume for a moment that there's a $42 out of the money strike. Now, that's a bullish position to take. Now, if that paid $1, that means that we are generating $100 per contract on a cost basis of $40 a share, $4,000 for the 100 shares that make up an options contract. So when we sell that option, we have an initial return of 2.5%. You could usually get that in 1 month. Now, that's just entering the trade. Now, if you're bullish on the overall market and if you're bullish on the chart technicals, then you would take a position like this and you have the opportunity to actually generate more than that 2.5% 1 month return, because if the price of the stock moves from current market value of 40 up to the out-of-the-money strike price of 42, you've now generated an additional $2. So your total profit potential is 1 plus 2, $3 on a cost basis of 40. That could be a 7.5% 1 month return. Now, that is a position you would take if you were bullish on the overall market, if the chart technicals were bullish and confirming, and if your personal risk tolerance allowed you to take that position. But the moneyness of the strike, which is the topic we're talking about right now, will actually dictate how we enter a trade, and it will be based on our overall market assessment and those few other things I just mentioned.
Good insights. Who wants to, and maybe, Ed or Peter, just speak a little bit to, in the money versus out of the money, intrinsic value versus time value. Peter, you want to start with that?
Yeah, sure. An option is made up. Option pricing. Option is made up of a couple components, and one is the intrinsic value, the in-the-money amount, and anything in excess of that we like to call time value. And I know we're a basic bunch here today, but it's important to mention that I know Alan mentioned earlier volatility. I want everybody to keep in mind that volatility only affects time value. So when you see these options that explode, that they have exploded in the last few weeks, it's that time value portion that increases in value.
And why does that happen, Peter? Why has that time value exploded over the last couple of weeks?
Well, they like to talk about it in many different ways on CNBC or the radio, the talk shows, but really what it all comes down to, you could label it any way you want, but it comes down to this, and Ed knows this as well, it's supply and demand. Ed might be in the pit and somebody comes in, OGR comes in and wants to buy 5,000 option contracts. He might get filled in all 5,000. Going to ask where the options are now. The underlying doesn't have to move, and those options are going to increase in value based upon the supply and demand for that particular option.
Okay, supply and demand, one reason. Ed, another thought on why these option premiums expand and contract sometimes so dramatically?
Well, certainly what's going on in the market plays a big role in that. The expectation for how much the underlying or the overall market could move in between today and the expiration date of an option plays a role. So if there is an increased expectation that the market may experience wider volatility in between that time frame, then you could see the time value explode, because in effect that's what time value is. It accounts for the potential of movement in the market, and for an in-the-money option to go in the money, or for an out-of-the-money option to become an in-the-money option. That movement of the market is what time value tries to capture, and as the perception of that time, of the movement within a certain time frame increases, then you could see time value increase. So to pick up on what Peter said as well, you have the in-the-money amount, and that's your intrinsic value, whatever that is, and then the time value is anything above and beyond that. So over the course of time, as each day passes, time value is what shrinks. Time value is what decays. And of course, as you reach expiration, on expiration day, there's no time left, so there's no time value left. And hence, at the expiration date, all you're left with is whatever intrinsic value there might be in the option, if any. So that's how time value can change, the perception in the market. And of course, as Peter said, the supply and demand of who's buying options to drive prices up, along with how much that underlying may move in between today and the expiration date.
So can I add one more?
I was just going to ask you, you've been talking about options on the sell side, and obviously, as premiums expand, your returns for the covered call increase. Do you want to speak to that some?
Yeah, sure. Let me just add one more thing to the time value, increase in time value. Certainly the overall market condition plays a huge role. That's a very, very important point. But it could also be specific to the particular stock that we're dealing with. A great example would be the increase in the implied volatility of an option prior to an earnings report, because there the market anticipation is tremendous. Is it going to beat consensus? Is it going to disappoint? And so the market expectation of the price movement of that stock prior to an earnings report is much greater than after the report passes. Therefore, because the implied volatility is higher, the option premium will be a lot greater. Now, to a new investor, they may say, that's wonderful, because I could generate higher premiums by selling call options right before an earnings report. The problem with that is that you're incurring a lot more risk, because the price of that stock, if it disappoints, can go down way more than the increased premium you generated prior to an earnings report. So one of the key principles in the BCI, Blue Collar Investor methodology, is to never sell an option prior to an earnings report. So that has to do with, on the sell side, I am turning my back on higher premiums because of the higher risk involved in the underlying securities.
Okay. That speaks to that discipline that all three of you guys have spoken to, and thanks for that point, Alan. We've got probably a little over 10 minutes, 10, 15 minutes to go. Stocks, indexes, ETFs, they can do one of three things. They can go up, they can go down, they can go sideways. How about if we take the last few minutes to talk about possible strategies that fit either a bullish, bearish, or neutral market? Alan, how about if I start with you? How about a bearish, or rather a neutral market strategy? Do you have? I think you might have a favorite. What you want to speak to that a little bit?
Oh yeah. Well, like I said before, Joe, when you're doing a strategy like selling options in a conservative way with covered call writing, you can actually take that strategy and craft it to the particular market situation. So if you're bullish on the market, and I look at the chart of the S&P 500, I look at the chart of the VIX, the CBOE Volatility Index. Some refer to that as the investor fear gauge. And I also take a look at the economic reports each week, and I make my overall market assessment. If that assessment is bullish, then I'm going to most likely go with an out-of-the-money strike. The example, let's say you have the stock at 40, you sell the 42 out-of-the-money call. Now, why is that a bullish position? Well, number one, you have an opportunity for two income streams in the same month with the same cash on the same stock. One from the sale of the option, and the other from share appreciation. It can go from 40 to 42. We talked about that before. Now, let's take a look at a bear market environment. We would then go with an in-the-money strike, maybe sell the $38 call and maybe generate a premium of $3. Now, we talked about intrinsic value before. The intrinsic value of that $3 premium is $2. We cannot count that as profit if we're buying a stock at 40 and agreeing to sell it for 38. So our time value component of that premium, our actual initial profit, is $1. That's still a 2.5% return. However, here's the advantage now, Joe, of the in-the-money strike. That 2.5% is guaranteed as long as share value does not decline from 40 to below 38. So the takeaway here is, and of course, if you're a beginner, you're going to actually have to see this, is that the intrinsic value component of a premium protects the time value component. So in a bear market, you're more likely to go with an in-the-money strike that will give you additional downside protection. Bull market, go with the out-of-the-money strike that will allow you the possibility to generate two income streams. One size does not fit all.
And Alan, that third possibility of really a neutral opinion, would you then sell the at-the-money if it existed?
Well, if we were smart enough to know that the price of that stock is going to remain the same, you're 100% right, Joe. Your best bet is to sell the at-the-money strike, because the at-the-money strike, example, buy a stock for 40 and agree to sell it for 40. That strike will give you the highest time value initial premium. So if we knew somehow that stock was going to stay exactly where it is, then the at-the-money strike makes the most sense.
Okay, and Peter and Ed, I'm going to get to you in just a second with some strategy questions. But Alan, the covered call and selling the put, same thing. Do you only buy stock and sell calls, or do you sell the puts as well?
Sometimes what I'll do, Ed, and here's a great, Joe, a great strategy for some of your new investors. And I don't want to put too much on them because it really took me years to get to where I am now. But you can actually use both strategies once you've mastered covered call writing. And that's the one I recommend that you start with because it's more intuitive. The price of the stock goes up, so the value of the option goes up. It's more intuitive, whereas put, kind of like looking in a mirror, it's inversely related. But a great strategy, if you could master both, is I call it the PCP strategy, put, call, put, where you sell an out-of-the-money cash-secured put to buy a stock at a discount, and then if it's exercised and you own the shares, then write a covered call. So, for example, let's say a stock is trading at 75, you sell the 72.50 out-of-the-money put for $2. Now, that gives you about a 2.8% return if it's not exercised. But if it is exercised, you now own the shares at a cost basis of $70.50. $72.50 minus $2 premium. And now once you own the shares at that discounted price, you could now write a covered call. It could be in the money or out of the money depending on your overall market assessment. So in a bearish market environment, I like the strategy of incorporating both selling cash secured puts and covered call writing.
Okay, good. And, we are Options 101 here, and we are covering a lot of areas. So I hope you listeners are able to keep with us here. Peter, having been in the pits for all those years, favorite bullish or bearish strategies?
Well, in the pits, it was mostly, selling front month options and buying something further out, which is what we call a calendar spread. Now that I've become a retail trader, like everybody on board here listening, I'm also a premium seller certain times. I do a lot of covered calls like Alan, but once in a while I get into the directional thing, and I like to do it with realistic expectations. So instead of just buying call options and hoping that the stock goes somewhere to the moon, I'm realistic about it. So let's just say I decide to buy a 50 strike call. That stock's probably not going to go to 80, right? So I'll sell another call on top of that where I believe the stock is going to land. So maybe I buy the 50, which is maybe 45 days out, and I sell the 55 strike call. So we're doing a few things here. The 55 strike call sale is actually going to finance the purchase of the 50 call, but then I'm also spreading off the risk of time and volatility to a certain degree. And once again, I know that we are options 101, but keep in mind when I'm buying options, I'm buying that enemy of time decay. And when I'm selling options, time decay is my friend. And so I like the fact of choosing strikes based upon a bullish sentiment, but also where I believe the stock just might land. And we call that a bull call spread. And once again, it spreads off those two very giant risks that option traders are exposed to.
And that short call that you're selling against the long call is really the target for the stock as you get closer to expiration, correct?
Exactly, yes.
Okay. How about on the bearish side? Anything? I mean, you mentioned neutrally. You're talking about the time spreads where you're long a little volatility, short front month options. How about the other way?
On the bearish side, I might do the vertical also, just this time with puts, and that has worked out well for me this year with Abercrombie, actually. Not to give anybody any advice, which I can't do, but again, it's all really about realistic expectations and choosing the strike price either on the upside or the downside as to where we think the underlying just might go. And I do play earnings. I find that earnings periods can offer me a lot of opportunity, and sometimes it is selling premium in advance of earnings. I know that some of us don't always do that, and sometimes it's also talking about direction in advance of earnings.
Well, you're talking my language with earnings, with volatility, with direction. If you would, Peter, speak a little bit just about the approach to volatility and the expansion and contraction of those premiums as we get to earnings and your experiences there.
Yeah, well, Alan did a super job of identifying that earnings, is uncertainty, and so is volatility. And so we've got the call buyers, we've got the put buyers jacking up both the calls and the puts in advance of earnings. Everybody's jockeying for position. And the purchase of all of those calls and all of those puts is increasing the value of those options. And we see that value increase big time about 10 days leading up into the earnings period. And Amazon is just the perfect chart. I think Ed was talking about charting and so forth. But Amazon, if those of you, here's your homework, look up Amazon during these earnings periods. You can just see the implied volatility, how it spikes in advance of earnings. Earnings are released. Earnings come out. The unknown is now known. And we tend to see the volatility drop. And with that being said, here's a pointer for you. If you're going to trade earnings, and you are long volatility, and you do get the move that you want, you need to recognize how much time premium is still left in that option. You may want to consider getting out of those long options within the first 15 minutes, first 40 minutes perhaps, because we're going to see that volatility get crushed more and more as the morning goes on.
Okay. Good advice. And Let me go back to you one more time, Peter, in terms of the bull and bear spreads, the vertical spreads. As we get close to expiration, how do you manage the delta in those spreads? Is there an easy way to do it?
Well, you know what? It's a great question. As I get close to expiration, I'm out. I very rarely hold any of my trades to expiration. And here's the main reason. When I first started out as a retail trader, it's a lot different. It's a whole different ball game than it was from the pits. When I see a profit that's suitable, comfortable, I'm out. I'm out of the trade. I'm not going to wait till expiration for any of my trades, because what happens sometimes, certainly, stock runs up, hits a ceiling, a lot of resistance, comes back down, and like, oh man, I should have gotten out of the trade, and I could have put the trade right back on again. You know, here I am getting emotional now. And I told you I don't get emotional about this, but no, that's the deal. You know, when I don't wait till expiration. I want to get out of those trades. Once I see that there's a handsome profit, I'm out for sure.
Excellent. Ed, talk to me bullish and bearish strategies.
Yeah, you know, I'm going to piggyback off that conversation you just had. I think the verticals make a lot of sense, especially from someone getting started in options. I've used them many times myself. And, you know, to just elaborate and take the conversation a little different direction, if you are bullish in a particular underlying, there's a few different verticals you can do. You can buy a call spread or you can sell a put spread. And those two different trades have different characteristics to them. For example, if you buy an out-of-the-money call spread, there's a pretty good chance your risk-reward is in your favor. But, of course, you need that underlying to move higher, and you're going to need a significant move in your favor. If you get that move, you can achieve really nice returns on your investment. On the other hand, selling a put spread, an out-of-the-money put spread, for example, doesn't necessarily have to have the move you're looking for. You might be bullish in the underlying, but maybe you're not so confident in that opinion. So you decide to sell a put spread that's out of the money, receive premium, maybe have a risk reward where if the trade works against you, it doesn't work out so well, but you will be profitable in that scenario if the stock doesn't trade anywhere and consolidates and trades neutral. So the likelihood of success could be greater if you're selling a put spread. Again, both of those trades would be bullish from the bullish perspective, but one is more aggressive than the other. And when you're comparing options trades to one another, you're likely going to find that there's an advantage and a disadvantage from one to the next. On the call spread side, you might make more, but you'll have a higher break even, and the stock has to go your way. The put spread might not have as good of a risk reward, but your chances of success are much greater because the stock can stay neutral, and you can make money on that. So that's what I point out about a nice feature of the verticals. And, of course, I do have a lot of familiarity with our website, as I'm sure the listeners do. If you went to the Strategies and Advanced Concepts section of our website, to the strategies, and you filtered through bullish and bearish spreads, you will be able to see these spreads fill in on the list that gets put up with results, and then you can check out the P&L graphs of each and compare them to one another.
And Ed, when you're talking vertical spreads, whether you're buying them, selling them, do you look at the delta of the spread, or do you just look at the strikes?
Well, you certainly look at the delta, but you know, I think Peter really hit it on the head. When you're looking at the strike prices, you are selling the option that you do not. You're selling the strike price of an option that you don't think the underlying is going to breach. So if I'm buying my call spread to the upside, I certainly would like to know what the delta is and monitor that to know how much my premium may move as the underlying moves. But I'm going to target the option that I sell at the strike price that I don't think the stock will breach above. Otherwise, I've given up potential gains. On the put spread side of things, if I'm selling a put spread, I'm going to target a strike price that I feel comfortable the stock will not breach beneath, because that's where I start to experience losses. So certainly delta is on the radar, but I personally would look more towards the strike prices and pick the strike price that I want to sell at a price I don't think the underlying is going to breach through.
Okay, very good. A downside strategy, anything you like to hone in on?
Well, certainly we'll keep it simple. The aggressive way to play that is by going straight out with the long put.
Okay.
If you were someone that doesn't mind buying shares of stock, you could do some kind of a ratio spread where buying a put and selling two further down strike price puts could give you a very more improved risk reward, lower your cost of the trade where you can still capitalize on a move lower down to that short strike price. But if you're wrong and it breaches underneath, you might be in a position where you have to pick up shares at that low price. So there's a few ideas of what you can do on the downside.
Excellent. Guys, before we go to closing thoughts, I want to ask you each if, for our listeners, you have a favorite tool or two and or book you'd like to offer as a recommendation. Alan?
Sure, Joe. On my website, I'm going to tell the listeners about the two most popular free tools that we have on our website, thebluecollarinvestor.com. One is called the Beginner's Corner Tutorials. These are 2 8-part video tutorials, one for covered call writing and one for selling cash-secured puts. Each video is about 5 to 10 minutes, and they have PowerPoint slides which can be downloaded for free. So just go to the website on the top right corner. You'll see the link. You'll put in your email address, and you'll have access to both tutorials. The other free resource is the basic element calculator, and you can get that by looking at the black line at the top of the web pages. It says free resources. Click on that, and you can have access to the basic element calculator, which will do all that math for you in terms of what is your initial return, how much protection do you have, how much upside potential if you sell an out-of-the-money strike. There's also a put calculator that we developed along with the user guides for both, and a lot more free resources. So just click on that and put in your email address, and you'll have access to those free tools. As far as books are concerned, Joe, I'll give you a non-Elman book, and I'll give you an Elman book. My first options book was Getting Started in Options by Michael C. Tomset. That was a very good beginner's book for options. And if you're going to get one of my books, the one that I would recommend is Alan Elman's Complete Encyclopedia for Covered Call Writing, the Classic Edition. I just came out with Volume 2, but you're going to want to read that Classic Edition first.
Very good, Alan. A lot of good ideas there. Ed, how about a tool or two and, a book if you got one?
Well, back to our website, the OIC's website, optionseducation.org. There's two tools that I frequently work with investors on that once they get introduced to them, they're very excited about. So I'd encourage everyone to visit our tools and resources section and check out the virtual trading system. The topic of paper trading was brought up today. And, of course, everything we offer is free of charge to the user. And once you register, which is free through our website, you can access the virtual trading system, which allows you to create a fictitious account, enter orders, place trades, create positions, monitor them, watch P&Ls, make positions adjustments. You can do everything that you would do in a live account, but through a virtual system that uses delayed quotes. So it's a practice tool. It's an educational tool. I tell investors all the time, don't pay too much attention to your P&L here. It's an educational exercise. So the virtual trading system there and the position simulator, also under tools and resources. You can enter a position there and track its P&L over time, changing a volatility level, changing days to expiration, and seeing how that profit or loss on the position is experienced. As far as books, the book I started out with right out of college, right to the trading floor, Sheldon Natenberg's book, Option, Volatility, and Pricing. It's probably a little bit more on the intermediate level, but for anyone that gets the basic concepts down and they want to start to get into the mathematics and the impact of volatility, certainly I'd recommend Sheldon Natenberg's book there. It was a book very widespread on the trading floor and certainly very well received within the industry.
Excellent, Ed. Thank you. And Peter?
Well, Ed just stole my thunder. I would say Sheldon Natenberg also. And the book was revised, I believe, last July. A little bit thicker, a little bit more detailed with the Greeks and so forth. And again, love it that Ed talked about the options calculator. We're talking about road testing a strategy, and it's right there on the OIC website. Love it as a learning tool. I think it's fantastic.
Fantastic. Let's see, I'm going to go to closing thoughts from each of you. Just one small bit of housekeeping. The slide I have up, just want to be sure, especially for those of you getting started, that you're aware that the industry does put out a document called Characteristics and Risks of Standardized Options. It's important that you get that either from the OCC or your broker before you get involved with trading options. So, Alan, if you would offer our listeners your closing thoughts on how best to get started in this crazy business. Okay,
Joe, I think what I'd like to do is let you know, based on my experience with dealing with retail investors, the two biggest mistakes that I see made all the time, because when you're starting out, you want to avoid these mistakes. The first one is starting too soon. And that means that people get very excited when we do seminars like this one or live seminars. They want to get started the next day, but they haven't really taken the time to master those three required skills: stock selection, option selection, position management. You need to do that to avoid losing money along the way. So take the time. It'll take about 3 to 4 months, paper trade, and then you're good to go for years and decades. The other big mistake that I see beginners, retailers, investors making is that they select options based on premium. You know, they see they can get 8 to 10% in 1 month, and they can't get enough of that particular stock and option. Just know that when you have a very, very high return, that means there's a lot of implied volatility attached to the time value component of that premium, which means you're incurring a lot of risk. If you're using a strategy like covered call writing or selling cash secured puts, you have selected a conservative strategy. So why convert that conservative strategy into a very risky one? So don't be enticed by high premiums. Understand the risk involved in all of your trades.
Okay, Alan, thanks so much. Ed, your closing thoughts?
Well, I just want everyone to stay confident and don't get discouraged as you're going through your education, because the concepts can be confusing. So stay disciplined and keep concentrating on these ideas. Focus on repetition as you go through your education, and keep in mind that options are a part of the puzzle. These options trades and spreads that we've talked about, they perform as advertised. And what that means is if the underlying moves in a certain way, the profit and loss that you expect generally is there, but that first piece of the puzzle is important. I know Alan's driven this point home as well. Choosing the stock and the direction and the timing of that directional move is paramount. If the options trade is chosen appropriately and managed appropriately, then you should have a good chance at being successful trading options. So when you're going through education, repeat things over and over. Don't get discouraged. It will sink in. You'll be comfortable, and then you'll start to dip in to your arsenal of options knowledge and choose the right trade. So stick with the program and use our website and other tools as often as you can, and hopefully you'll be able to sooner rather than later get your options started trading.
Thank you, Ed. And Peter, to close us out before we go back to Nick?
Sure. You know, great comments by both Alan and Ed. And, you know, I think about this a lot, that it takes about 2.5 years to learn this stuff. It takes time. At some point, though, you're going to have to dig in. You're going to have to jump in the deep end of the pool, you know, like I did in first grade. But with that being said, think about this, everybody that's listening right now. How long would it take me to learn your job? 60 minutes like today? No, no way. So it is all about education. Keep in mind, there's wonderful education on the OIC. We've got some great seminars that are coming up. We've got some more webinars coming up that I know I'm going to be on, as well as some of the other guys. And as far as our website, CBOE.com, we've got some really good educational videos out there. Like I said at the onset, there's a lot of free education. Use it. Use it for sure. It's all out there, and continue to educate yourself, and good luck, everybody. Thanks for joining us today.
Well, Alan, Ed, and Peter, thanks so much. I'm going to turn it over to Pete. And listeners, I hope you enjoyed this as much as I did. Nick?
Ladies and gentlemen, thank you so much for your time today. I know we went a little bit over, and we did have quite a few questions come through from our listeners today. So if our panel wasn't able to address that question or what you wanted to hear, please contact our investor services desk, of which Ed from our panel is a member of that team, and they're always ready to help. You can reach out to them by emailing options@theocc.com. That's THEOCC.com. Today's session will be archived and accessible in just a few hours using the same link you used to join us today. Additionally, our previous webinars are also available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. Our panelists today mentioned the OIC's website, optionseducation.org, so please check that out and see the Getting Started section on the top navigation bar for further reading. And of course, make sure to check optionseducation.org in the upcoming weeks for our next online sessions. Our next webinar will be held on February 16th, when we'll be discussing the concept of risk management. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.